Welcome back to Nomad Margins. This is week 11. We have officially crossed into our second decade of weekly updates, and if week 10 was about de-risking, week 11 is about stabilization, precision, and watching a calculated plan finally settle exactly how it was designed to. Last week, we were celebrating the fact that our margin status turned from an anxious, high-risk orange into a beautiful, low-risk green. But today, the account metrics have updated to something even more satisfying. Our status window doesn't just read low risk anymore, it officially reads a calm, solid, and verified, ready to use. We have broken entirely out of the defensive corner we were backed into, and the portfolio is sitting at a total value of $2,021.35. Let's look into the daily performance numbers before we tear down the back-end infrastructure. Today alone, the portfolio caught a fantastic bid, moving up $33.54, or a clean 1.69% gain during regular trading hours. We did see a minor after-hours cooling period, shaving off a slight $1.08, or 0.05%, but looking at the bigger historical trends, the trajectory is undeniable. Over the past week, we have surged up a massive $348.84, marking an incredible 20.86% gain across the capital base. If we pan out to the one-month chart, we are up $337.11, which translates to a solid 20.02% return. 3 months out, we are up $432.28, a 27.20% increase. And looking at our absolute year-to-date baseline, we are sitting on a beautiful $432.32 profit, pacing our account at a 27.21% year-to-date gain. Now, let's open up the buying power window and look at the exact financial engineering that has unlocked this absolute peace of mind. Our total available buying power has climbed to $1,942.09. Look at how beautifully structured this breakdown is now. We have $1,073.62 in cold, hard, pure uninvested cash. That is backed by a margin total of $1,468.47, with $600 safely locked up as options collateral. Because we scaled up our pure cash cushion to over $1,000, our margin health has reached a state of near invincibility for an account of this size. If we pivot over to our official margin health screen, you can see the absolute fortress we've built. Our total maintenance requirement is sitting comfortably down at $800.93. Because our portfolio value is holding strong above $2,000, our actual margin available to invest stands at a wide, breathing room level of $1,468.47. We are no longer playing defense against the broker is giving us the green light to strike whenever we see the right probabilistic opportunity. Let's look at how our concentrated asset allocations are positioned going into the next macro cycle. When we look down the list of our core holdings, you will notice a leaner, highly focused setup. Our primary growth engine, VUG, our Vanguard Growth ETF anchor, is holding a concentrated position of 4.63 shares. At its current market price, this position accounts for a total equity value of $414.10. This gives us clean, blue-chip growth exposure with a minimal maintenance ratio, meaning it requires very little of our capital base to preserve. Next up is our defensive market hedge, GLD, our SPDR Gold Shares anchor. We hold exactly 0.81 shares, representing an equity market value of $339.08. Gold provides a brilliant, non-correlated cushion on heavy red equity days. Finally, our long-term dividend growth anchor, Waste Management, ticker symbol WM, sits at 1.15 shares with an aggregate value of $243.02. This is the ultimate defensive, cash-flowing rock in our portfolio, keeping our foundation completely stabilized. But as you all know, the real strategic velocity of the Nomad Margins journey comes down to our mathematical execution in the options market, and the scaling we have achieved here is absolutely insane. If you look back just 6 weeks ago, we were generating a modest $15 a week from our options plays. We were testing the waters and learning the ropes. Today, through consistency and scaling our high-probability setups, we have pushed that engine to over $100 a week. Just look at the realized numbers for proof. This week alone, we locked in a massive $131 in premium. That scaling has pushed our total options income for the month of May to a beautiful $207, and it brings our absolute year-to-date options profit to $263. We are actively creating a high-velocity income stream on the side that completely dwarfs what this portfolio used to pull in. Right now, to keep that momentum rolling, we have an active, vertical credit spread working on the NASDAQ 100 Index product, QQQ. We are currently running a QQQ put credit spread with an upcoming June 5 expiration date. The structural setup on this trade is incredibly precise. We have written 6 credit spreads, giving us a highly managed risk profile. This spread currently carries a 100% maintenance requirement of $552, but because our cash reserves are so robust and our asset maintenance requirements are so low, we are supporting this active premium engine with zero stress on our capital health. We are utilizing structural decay in high probability zones to continuously yield cash directly into our uninvested balance. 11 weeks in, and the transformation of this portfolio is complete. We went from fighting an urgent orange high-risk warning with a dangerous $100 margin buffer to holding a beautiful, optimized $2021.35 balance that is verified green and completely ready to use. We have built a cash fortress, locked down our downside risk, scaled our options engine by multiples, and created a highly automated income engine that can withstand whatever volatility the broader indexes decide to unleash. If you want to track every single one of my real-time options entries, protective strike adjustments, and daily portfolio metrics before we record our next update, make sure you are following me live on Blossom Social at Nomad Margins. Question of the week. Now that our weekly options income has broken past $100 and our portfolio is sitting steady above $2,000, should we continue to aggressively scale the contract sizes on our QQQ vertical credit spreads, or should we funnel this fresh $131 from this week directly into adding more shares of VUG, GLD, and waste management to compound our long-term equity core? Let me know your mathematical breakdown in the comments section below. I'm your host, this is Nomad Margins. Keep your risk managed, keep your cash high, and I will see you right here for week 12.